Hello everyone! In this video, we're delving into a critical topic, the array of actions governments can take during a financial crisis. Financial crises can send shockwaves through economies, and understanding how governments respond is vital to navigating these turbulent times. Now, here's the thing. Financial crises aren't a one-size-fits-all scenario. Different crises, different economies, and different governments can lead to varied responses. What's crucial is grasping the overarching strategies governments tend to employ to stabilize economies, restore confidence, and pave the way for recovery. In this video, we're peeling back the layers of the playbook governments resort to during financial crises. We'll unravel aspects like monetary policy adjustments. While some governments indeed opt for lowering interest rates, you might be intrigued to know that others might choose to tighten borrowing in pursuit of long-term recovery. But that's not all. We'll also journey through the realms of fiscal stimulus, regulatory interventions, and the crucial task of maintaining financial stability. Keep in mind, though, that while we're painting with broad strokes, the real picture can have fascinating twists and turns. When faced with a recession, central banks roll up their sleeves and get to work. Their go-to tool? Lowering interest rates. So, what happens when interest rates drop? Well, borrowing money becomes more affordable. Picture this. Consumers find it easier to finance big purchases like homes or cars. Businesses, on the other hand, can seize opportunities to invest in growth. And here's the big picture. All of this activity, increased consumer spending, and business investments, adds up to an economic boost. Lower interest rates essentially grease the wheels of economic activity. But wait, there's a catch. While lower rates can be a game changer, they can also bring risks like asset bubbles. Central banks must walk a tightrope, juggling the benefits with these potential challenges. To sum it up, central banks roll out the big guns by lowering interest rates during recessions. The goal? Spark borrowing and spending, which ultimately breathes life into the economy. Let's also talk about the flip side to lowering interest rates during recessions. While it can be a powerful tool, it's not without its potential pitfalls. You see, when interest rates drop, borrowing becomes more enticing. This can lead to excessive borrowing for investments like real estate or stocks. As more money flows into these investments, their prices can soar rapidly. This exuberance can create asset bubbles when prices detach from their actual values. And here's the concern, when these bubbles burst, it can have a domino effect, impacting investors, financial institutions, and the broader economy. So, while lowering rates can stimulate growth, central banks must carefully balance this move with the potential bubble risks. Another powerful tool that central banks deploy when the economy is in crisis is quantitative easing. Quantitative easing, often abbreviated as QE, involves a strategic move by central banks. They step in and purchase financial assets, such as government bonds, directly from the market. But what's the purpose of this maneuver? It's all about increasing the money supply. By pumping money into the system and buying these assets, central banks work to lower those stubborn long-term interest rates. Here's the key, QE isn't just about monetary mechanics. It's about boosting economic activity. By reducing long-term rates, QE aims to spark lending and investment. It's like giving a gentle push to both businesses and individuals to make things happen. So, when conventional tools like cutting interest rates reach their limits, central banks turn to quantitative easing. It's a strategic move with the ultimate goal of reinvigorating lending, investment, and overall economic vitality. Fiscal stimulus, which involves government actions to boost economic activity, is another vital tool that governments use to kickstart economies during recessions. This is achieved through increased public spending or tax cuts. The goal of this tool is to pump more money into the economy. This surge in funds leads to a rise in consumer spending and a buzz of activity in the business world. So, what does fiscal stimulus look like? Think infrastructure projects that create jobs, unemployment benefits that help individuals make ends meet, and tax rebates that put money back into people's pockets. When economies hit a rough patch, fiscal stimulus is like a financial jumpstart. It's all about boosting economic momentum. In times of financial turmoil, structural reforms take center stage. These are substantial changes that reshape core economic elements, such as labor markets, regulations, and trade policies. When the storm hits, why consider structural reforms? These reforms, though complex and challenging, inject a dose of long-term resilience into the economy, helping it weather the crisis and emerge stronger. Picture revising labor market regulations to bolster job creation, streamlining business rules to foster innovation, and optimizing trade strategies to enhance global competitiveness. While swift actions are vital during crises, structural reforms remind us to balance urgency with forward-looking strategies. And there you have it, a glimpse into the intricate world of government actions during financial crises. Remember, economic storms are navigated with a mix of strategies, and governments step up to guide the ship. If you found this video insightful, don't forget to hit that like button and share your thoughts in the comments. For more engaging content on economics, policy, and navigating financial landscapes, be sure to subscribe and ring that notification bell. Thanks for joining us today. Stay curious, stay informed, and keep exploring the dynamic world of economics. Take care.